Hi, I'm James Dunn. Welcome to the Inside Network. Joining me and going in depth today is the Director of Factor Strategies and Multi-Asset Investing at Invesco, Scott Bennett. Welcome, Scott.
Thanks, James. Pleasure to be here.
It's a great pleasure to have you here. Scott, given where we are in the economic cycle, where does investing in small caps currently sit within a portfolio, and what role does it play?
Yeah, so small caps by nature are generally more volatile than larger cap companies in general, so they generally sit at the riskier end. And in terms of where we are within the economic cycle, we've gone through a period over the last 3 years of probably one of the most substantial amount of rate rises consecutively that we've seen in a long period of time. And through that period, those higher risk allocations have generally underperformed. So if you think about things like emerging markets and also smaller companies have struggled over probably the last 3 to 5 years. That's because those companies by definition are much more leveraged to the economic cycle and have much greater sensitivity towards interest rates. Now, where we see ourselves in the current investment cycle is we're starting to see bond yields come down. So the market's pricing in interest rate cuts going forward, and we've already started to see central banks around the world start to move that way, and we believe that that'll continue. So as we start to move from a rate rising to a rates falling, that's really going to benefit smaller companies much more than it is larger cap companies because of that interest rate sensitivity and that economic sensitivity of those companies. So we think for investors, it's a great time to start thinking about allocating towards small caps to really ride that wave of continued interest rate easing.
It's really interesting when you look at the small cap space. All of a sudden, you're looking at a completely different share market than if you're looking at concentrating on the top 20. The weightings are so different, the range of exposures, the industry sectors is so much broader. Do you really view it as almost the second Australian share market?
You can actually view it as that. So if you look at the way that we design these indices or these representations, so generally things are capitalisation weighted, but they do represent a significantly different opportunity set than large caps. And so if we think about those top 20 securities, really you're dominated there by, say, 4 banks, 3 resource companies, 2 supermarkets, and 1 healthcare company. So really not a diverse exposure at all within that top 20. Well, when we look at the smaller ords, or the Small Ords Index, it's a much broader set of companies at various different stages in their life cycle. So that top 20, for example, very well established businesses, very repeatable earnings profiles, very solid dividend profiles, where at that smaller end, you've got a wide range of companies, and that presents significant opportunities, especially for active investors.
One of the big trends in wealth management over recent years, Scott, has been the advent of passive vehicles, and partially to reduce the fees that investors pay, but there's a number of reasons why they've been really successful. Does that approach succeed in the small cap space?
Yeah, so passive investing has gained a lot of traction over the last decade, if not the last 2 decades, and we're starting to see actually the majority of assets invested around the world is actually passive. And there's good reasons for that. So by passively investing, especially in capitalisation weighted indices, you're really weighting your portfolio towards success and away from failure, in that you're giving more weight to those companies that are doing well and less weight to those companies that are doing poorly. And also at the large cap end, successful companies get promoted in and poor performing companies effectively get relegated out. Now, although the weighting structure is the same for a small cap index, the mechanics of how that's applied actually result in some unique outcomes. So for a small cap index, if you're a really successful company, you actually get promoted out. So small cap indices by design are exporting success, and generally what's happening is you're importing failure as effectively those large companies that get relegated out of large cap indices start to dominate the exposure in small cap indices. So where you've got large cap passive vehicles effectively weighted towards success, for small cap indices, they're generally weighted towards failure and also hope. And so we think that when you're looking at small caps, you really want to take a different approach than what you might be doing for large caps. And definitely as a passive investor, you're leaving a lot of opportunity on the table that can be easily garnered.
Is there an argument that because it is a less efficient market in terms of information, there can be an advantage for active managers that get into stocks earlier and know the story really well and can get well positioned, and that in effect it's an easier task for an active manager to outperform in small caps?
Yeah, I think that's part of it. The big opportunity we see is actually not so much getting into the right companies, but making sure that you're not exposed to the wrong companies. And that's the challenge that we see with passive small cap investing, is that there's a lot of really high growth, very successful opportunities within that space, but there's also a lot of pitfalls and challenges that you need to avoid. And we think that those companies that are easy to avoid, you can do that fairly easily through a systematic approach.
What is systematic investing, and how is that applied in practice to a sector such as domestic small caps?
So systematic investing is really just fundamental investing. And so whether it's a milk bar or a mining company, what we're looking to do within systematic investing is really just identify those key ingredients that make for successful investments and avoid investing in those companies that have historically proven to be unsuccessful. And so the idea what we're looking at systematic investing is we have really three key components. So one is what we call momentum, but this is effectively growth. The other one is the quality of the business. So this is, does it actually make a profit? Are those profits sustainable? Mm-hmm. Is management good quality? And then the third thing is, for any investment, what's the valuation? So what's the price you're paying for the company that you're buying? And whether it's over an extended period of time, what you've seen is that if you invest in high growth companies that have good quality balance sheets and good quality earnings at a reasonable valuation, you'll do well. And this is very similar to what Warren Buffett does within his own process. The difference between traditional active manager and a systematic one is that we're able to apply those insights not across a small number of stocks, but across the entire universe, and do that without judgment and without behavioral bias. And what has also been shown is that if you invest in the counter of that, so these low growth, low quality, high valuation or expensive companies, you generally do very, very, very poorly. And just to give you an idea in terms of the Australian market context, investing in those low growth, low quality, high valuation companies, over the last 23 years, you would have earned a negative return of 1.5% per annum. But if you take the counter of that and those high growth, high quality, low valuation companies, over that same time period, you would have generated a return of 11.5% per annum.
Compared to stock picking and manager skill, is this systematic approach gaining traction, and is it likely to endure, especially given that technology such as AI promise to make markets more efficient over time?
Yeah, so the idea of investing in high quality, cheap companies has been around for a long, long time. So we can go all the way back to Graham and Dodd, which was about 96 years ago, and obviously kind of the professors for Warren Buffett. In their seminal book, they espoused high quality value investing as a key determinant. Now, that was over 90 years ago, and we've seen dramatic advancements in technology since then. So if you think computers didn't exist then, and now we're kind of coming up to a new iteration of technological advancements. But those concepts have endured right through all those stages of technological advancement. And we think with generative AI, the opportunities only get greater for fundamental and systematic investing, because what we see is a lot more noise coming into the market, and that noise presents significant opportunity for all investors.
Scott Bennett from Invesco, thank you very much for going in depth with me.
Always a pleasure. Thanks, James.